trading in Asia this morning at $82.71, down a little bit on this morning's trade, down about 0.5%. Not a great move, but nonetheless, it's been a somewhat surprising move in essence that the trend this week has been essentially neutral to bearish, despite what appears to be the collapse of ceasefire outlook in the Gaza and the unknown of what exactly is going on in terms of what appears to be now an escalation in that war, with the dreaded attack on Rafah, which of course everybody in the world has said don't do, including the President of the United States, who seems to be just a bystander at this point. Niamh McBurney, Associate Director, Control Risks. Unlike Neil Atkinson, who doesn't have to earn his money by acknowledging the frank not knowing what's going on in geopolitics, you have to pay the bills by doing so. So we'll put you on the spot this morning to sort of give us some sense of what you're reading, what Control Risks reading is of the developments of the last few days. Hamas agreed to what appeared to be a deal that was generally agreed to by everybody. Then Israel said they didn't agree to it. Where do you think we're at, and where do we go from here?
Thanks, Sean. It's great to join again. And yes, I don't have the same luxury as Neil. So to give you a sense of where we think things are heading, we expect that there's going to be a sort of parallel process here where the Rafah operation gets underway. It is politically necessary for Benjamin Netanyahu to go ahead with it and to deliver on his promise to remove the security risk that Hamas poses. He's been committed to that really since the beginning of the conflict, on the 7th of October. And so it is politically untenable for him domestically within a certain constituency, particularly the most conservative constituency in Israel, to not go ahead with this. And it will also help him by time to frame his argument for staying in office, at least for the rest of this year. But then alongside that, we're expecting the negotiation process to continue. The Israelis were frankly quite embarrassed when Netanyahu didn't send a delegation at the weekend to be a part of the talks that, as we now know, the results of
embarrassed. This Israeli government has the emotion of embarrassment. That's
not overtly appearing so, but definitely, I think Netanyahu's quite angry reaction in the last 24 hours showed, and now that they are sending a delegation, shows that they've been put in a bit of a corner here. But I mean, to speak to the poll from yesterday's session, that sort of finely balanced view on whether this is the beginning of the end or the end of the beginning. We do expect this to continue for some time, certainly weeks, possibly months. But it is our kind of Control Risks view at the moment that this is probably the beginning. Well, the beginning of the end, if we're thinking in terms of Gaza. Certainly, because this will event the end of the Rafah operation once it ends in weeks, potentially months, although probably will kind of wind up during the summer, just because the heat, frankly, is horrendous. We do think that will lead to a kind of a general de-escalatory process, probably through to the end of the year. But then if we look on the other side from the regional angle, and we can get onto this later, this is probably the end of the beginning when it comes to that sort of broader conflict between Israel and Iran that we saw factored into the risk premium for a couple of weeks and now has very much been removed from the oil price. But that will also keep lingering on in the background as well and could flare up at the end of the year.
Neil Atkinson, former head of oil markets division at the International Energy Agency. Neil, with Brent at 82.71 a week ago, it was at 89.71. It was about $7 higher. Is there any geopolitical risk premium left in this Brent crude oil price?
Well, I don't think so. We've seen since October the 7th and since the attacks by the Houthis in the Red Sea that the impact on actual oil market operations has been pretty minimal. The Red Sea attacks have just led to oil being rerouted as opposed to supply being denied. And I think, we know, without wanting to tread onto Neem's territory, it's not in the interests of the United States or Iran for the Middle East conflict to escalate. Iran needs oil exports and oil revenues. The United States wishes to avoid, at almost any price, rising oil prices in an election year. So I always thought there was relatively little risk of an escalation involving Iran and the United States. So yeah, I don't think there is very much risk premium. Russia and Ukraine, which is the other conflict, of course, which is hugely important, that is just grinding on in almost like a First World War tribute act, so that they gain 10 meters one day and lose 10 meters the next. So I don't think there is a lot of risk premium in the price at all.
Let's welcome back to the table Salah Yilmaz, Senior Energy Equity Analyst at Bloomberg Intelligence. Salah, we've seen, maybe like many people, Reuters struggling to make sense of the oil market, but they're saying that the edging lower today is on the nostalgic reasons of rising US stockpiles. It nearly seems like the 1980s again when such things had an impact on oil prices. Your thoughts on their analysis that indeed rising inventories are guiding the market, the idea that there's ample sort of supply on the side here?
Yeah, I mean, I haven't seen their analysis exactly, but one thing I would say is that I generally do agree that we didn't think there was a big geopolitical risk premium on prices anyway. I think.
So what then was the $7 that came out of the market last week?
Maybe some reaction to the geopolitical developments, but mostly I think some indicators on the physical market side. It seems that the market is showing some signs of weakening. Demand hasn't necessarily been bad this year, but it hasn't been particularly great, and the outlook remains quite uncertain. When we look at refining margins, they have shown quite a lot of resilience in the first quarter, but we are hearing some companies say that the second quarter is probably not going to be as good, or the rest of the year, and especially for diesel, these processing margins seem to be falling. And yeah, to your point, these weekly numbers, they don't always matter, but it is showing that the US output is at a record level. And the demand in the US, again, we get mixed signals week in, week out, but this week's it seems to be looking not particularly too strong. So again, going back on the geopolitical risk premium, we actually ran a survey that I think I talked on this podcast as well back in February. And one of the questions was what geopolitical risk premium that our respondents thought was attached to prices. And the majority actually said back in February that it was less than $5 a barrel. A big chunk actually said less than $3 a barrel. And then an analysis that Bloomberg Economics here recently did was showing that a lot of the price increase so far this year was actually probably demand driven rather than supply. Back to Neil's point also that, tensions were high, but we haven't really seen a big impact on supply. We haven't really seen any supply disruptions per se. So I think, again, sometimes it's the market may be focusing on geopolitics, but it seems to be focusing on fundamentals right now, which makes, I think, the next OPEC meeting in a few weeks' time quite interesting in terms of what they do in the second half of the year.
Niamh, just to circle back to the situation in Gaza, or more the ceasefire discussions, putting aside, what might happen in the wider circle of Iran-Israeli relations, or even in the West Bank later on, and what is happening in the West Bank. But this deal of the last week, a week ago, we were being told that at least the general proclamation from the likes of Blinken visit to the region and so forth, that all is up to Hamas to accept this deal. It was the best deal. It was and the indication there was that everybody was on the same page, i.e., the Egyptians, the Americans, the Qataris, and the Israelis, and all we needed now was Hamas to come into the room. Hamas came into the room, and Israel ran out the back door. What is the sense there of that dynamic? The idea that the deal was essentially done and it was just waiting for Hamas's phone call. Was Israel not already on board with this deal?
It certainly appears it wasn't. At least that's
Appears
the
now, but
well, I mean, there's still uncertainty as to whether it is fully on board. So it sent over a negotiating team yesterday to Cairo. CIA head William Burns is.
but come, I mean, was Blinken then? I mean, it seems if Blinken was misleading everybody then last week by saying this was all up to Hamas. I mean, that's what he said categorically over and over in his visit to the region.
Is it misleading, or is it a particular kind of perception on the part of Blinken and the Biden administration? Because, you know, they do have a very different view of this than, well, those of us on the call and those of us in the region. I suspect they were kind of under that impression. But we also have to remember the wider context, particularly in the last 2 weeks, of the criticism that's been focused against not just Hamas, but the Qataris as well, for playing the mediator role that they have. I mean, broadly, effectively. It has taken time, but you know, now very clearly in the last few days, it's shown that they have delivered. But nonetheless, you know, this time last week they were threatening to withdraw from the process entirely because they felt that their reputation and the role that they were playing was being and it was not appreciated, to say the very least. That they used stronger language themselves in official statements. So I think that speaks to the kind of complicated dynamics of this, and frankly, fundamentally, how far apart some of the parties still are on all of this in their understanding of not necessarily what's on the table, but the overall conditions in which everyone is operating. And I think for as long as that mismatch of understanding and perception continues, which, I mean, it clearly is, at least from the Biden administration's point of view, you know, they hold very, very different views to other governments, Egypt and Qataris. Bill Burns's presence in Cairo now is a positive sign, but nonetheless, you can tell that in DC that, you know, there is a misalignment there. I think that's going to probably cause problems, you know, over the next couple of weeks and months as we get into the later stages of negotiation, as the conflict starts to wind down. There's a risk that misunderstanding leads to kind of new eruptions or changes in the status quo.
And
so,
what
so not great outlook, to be honest.
In the interim, you're seeing a full invasion of Rafah, which is sort of like the horror story that everybody is warned against, including President Biden.
We are expecting a considerable presence. How you define full invasion is well, kind of in the eye of the beholder.
Well, the tank goes down the street, it points its gun, and it shoots.
And it moves along with flags as well as pictures that we've seen from social media. So there will be a considerable military presence, tanks and others. Netanyahu has made clear that there's 4 battalions that they think are present still in Rafah, and that also the leadership is probably hiding in the tunnels underneath. That's the Netanyahu administration's view, and the IDF are probably going to follow through on trying to you know,
I mean, all in all, the question, right, I come back to Blinken last week, is it does strike me that if indeed the Americans are that weak, it doesn't bode well for any of this process, that they could be so disconnected from where they perceived the facts to be in terms of the negotiation. Neil, meanwhile, back at the ranch, so to speak, OPEC Plus is getting close to their own decision. Under all of these sort of basic fundamentals, does OPEC Plus have the opportunity to start unwinding its cuts as it meets, when it comes to meet on the 1st of June?
Well, I hope they miss the opportunity to take an opportunity, frankly, because I don't think they will unwind the cuts. I don't think they should. The signals we're getting from the market would indicate that, as Sally was saying a few moments ago, you know, the demand in the United States, which is the biggest single market, opened up in January reasonably okay, but in February the numbers are not so good. The Fed seems to be rather more cautious about cutting interest rates. It's not satisfied that the inflation target is being reached. Europe, of course, remains, you know, mired in misery, gloom, and despair. You know, we still think that demand is going to rise pretty solidly this year. But on the supply side, there are no interruptions. I mean, the only place in the world which has got any kind of conflict which is significantly affecting flows to well, not even significantly affecting flows to the market, is in Sudan. but that's, pretty small beer. Russia continues to export very large volumes of oil and continues to rake in all the revenues. We see continued high production in the United States and in Brazil and in Canada and in Guyana. So the market is, I think, as far as the OPEC Plus ministers are concerned, is in a good place. If the price holds at around $80 a barrel, give or take, for Brent, I think they will be pretty satisfied with that. And, after June the 1st, they live again to fight another day. So my personal bet, which I'm happy to go big on, is that they will take no action on June the 1st.
Salo, we had BP and other majors obviously reporting earnings recently. BP profits yesterday sliding by 40%, and they're pledging to cut costs. Your thoughts on the results from the majors, what it might mean and translate to in terms of their willingness to invest in new capacity and other such things?
Sure. So we had a mixed set of results across majors. I mean, BP was one. We also had Shell in the US, Exxon, Chevron last week, and Aramco yesterday, actually. So for BP, it was actually a slight miss only. I mean, we knew that their profits were going to be down just across the space. They did have oil price strength, but on the natural gas side, they had some weakness. I think a lot of investors were looking at buybacks, and they're keeping a pretty stable pace of buybacks, which is generally encouraging. But yeah, this new $2 billion cash cost saving target is new. I think they're following the footsteps of Shell, where this has proven to be quite effective. When we look at Shell, they actually had a beat. The production was up. Again, oil prices were still at a pretty favorable level, and this cost strategy that BP seems to be following delivered pretty well. Also, 2Q buyback pace kept stable, which investors were looking at, and it seems like these shareholder returns, are still a priority for these majors. And very briefly on Aramco, because I thought this was interesting yesterday. I mean, broadly as expected results at an operating profit level and net profit level. We knew that their output is still limited at around 9 million barrels per day because of the OPEC Plus output cuts. That was no surprise. And they seem to be on track for the dividend delivery of $124.3 billion in total dividends this year. That's the base dividend plus the performance-linked dividends, and per quarter that makes about $31.1 billion, which is exactly what they showed. I think the interesting part here is that this is higher than their free cash flow generation per quarter. So we expect they currently have a net cash position, which is I mean, their balance sheet is one of the strongest, if not the strongest, across the majors globally. But at this pace, they will see their net cash position drop by between $8 to $9 billion per quarter. I mean, looking at the consensus estimates for free cash flow for the rest of this year. So
I suppose in the rear view mirror, it makes sense why they backed away from their commitment to increase to 13 million barrels a day.
I think so. And clearly dividends, a big chunk of which obviously goes to the government and to the PIF. I think it just made sense. And I mean, I think the question, perhaps not for right now, but maybe for later in the year, is whether they, extend these performance-linked dividends into 2025. Because I mean, as you know, the kingdom does have very ambitious diversification projects, and these dividends
and needs
help.
money.
Yeah, exactly.
Let's go to the survey question, which sort of touches on the earlier points of where we're at. The US, since yesterday, has come out with this statement that the US believes negotiations on a Gaza ceasefire should be able to close the gaps between Israel and Hamas. No time horizon on that, but nonetheless, you would imagine it is in the immediate sense of the recent days that the US believes that this gap can be closed. Israel has said that they would they would stop their assault on Rafah if indeed, at least if I understood it correctly, Hamas was to release one prisoner, would release their first prisoner, I think the language was, which first hostage as such, and then Israel would start to release its hostages. Of course, it holds thousands of Palestinians in Israel detained without charge or conviction. But that's do you agree or disagree with this U.S. belief that indeed they should be able to close the gap that has sort of avoided them for some time? I suppose the other part of that question has to be, or that statement, well, it all depends how much muscle you want to use, Mr. Blinken. Niamh, just coming back to Neil's point about the OPEC outlook here, is this a pretty easy decision for them? I mean, prices in the low 80s, no need for changing anything. Your thoughts on the kind of decision OPEC Plus is facing?
I'd just like to say that I absolutely agree with Neil's position, and you know, on the kind of broader environment, and we, although we don't do kind of detailed oil markets analysis, we don't necessarily think that they need to react to the environment now. I think an extension of the cuts would sit kind of comfortably within the kind of decision-making process that needs to happen. I want to kind of go back to a word that Salah used earlier, which is uncertainty, and the amount of uncertainty in the market as a whole, and then also in the geopolitical conditions that have influenced the price over the last couple of months, but nonetheless, we can all agree shouldn't have actually made a difference to the price, if that makes sense. You know, the algos trading off keywords in headlines that is distinctly unhelpful, because it hasn't actually changed the facts on the ground when it comes to the physical market itself necessarily. Yes, there's been rerouting, but you know, that's all been fine. So yeah, it's in some ways it's quite a difficult decision that they've got to make. But what I would say is that we probably have a sense of the types of discussions that they're having by now, sitting a month out from the meeting on the 1st of June. And there haven't really been any substantive murmurings. I mean, there was quite a big reaction on social media yesterday to Novak's comments on the potential for increasing. But really, I think that was just because we were reacting to a vacuum of information, as it were. But broadly, if you think of both the market dynamics and the geopolitical considerations, with the price sitting where it's at, you know, for OPEC's you know, countries and government budgets, it's sitting pretty comfortably. They're not going to want to do anything that fundamentally, you know, shifts this. And we also need to bear in mind that if they are going to have the discussion about, say, increasing output slightly, then, you know, that's going to mean a fundamental reassessment of the strategy, which I think we would have started to hear little whispers about by now. So no, I suspect, like Neil, that they will just continue. Maybe they shorten the time frame for their assessment. Maybe they kind of turn around and meet in you know, the end of July or early August to try and provide the market with more signals. You know, through the second half of the year. I think that, you know, that's something that they could do amongst other tools that they have. But broadly speaking, I mean, as we've all commented on, you know, the market itself is pretty stable. Certainly, it is to some extent unfavorable for OPEC. So in the absence of any major changes, you know, kind of continue on as normal.
I suppose it's not broken, don't fix it. Neil.
Exactly.
Looking out your window there in Paris, I'm not sure if you saw President Xi walk by, but the Chinese president was around, and he's just headed off to Serbia, landing in Serbia today to visit on the 25th anniversary of NATO's bombing of the Chinese embassy. Hardly a coincidence. Your thoughts on his visit and this on this sort of anniversary into Serbia piece, but the visit to France, comments yesterday by you know, the French president, somewhat you know, conciliatory and reaching out to China, and then Ursula von der Leyen came forward with a fairly big hammer to hit him on the head with. But your thoughts on the Chinese visit and what it means for that relationship and maybe for Ukraine, Russia?
Well, as far as the visit to France is concerned, I think any idea that France, or indeed any other country such as the UK, is really going to have a material impact on the decisions and the policies of the Chinese government, I think you're in dreamland. China plays a long game; it has very clear interests of its own, and the visit to France is unlikely to yield anything of great importance other than blocking up the traffic, which it did on Monday when I came back to Paris from London.
I suppose there was a certain question before his visit as to whether he could crack any daylight between Europe and America, between Washington and Brussels. And Macron kind of signaled maybe a little bit of daylight, and Ursula von der Leyen saying no daylight.
I don't think there's too much to that, frankly, Sean. I mean, China plays a long game. It has a close alliance, however you want to describe it, with Russia, and it plays its own very, very long game. The trip to Serbia, as you say, is hugely symbolic. 25 years ago, what happened? Of course, it was an accident. It was an error. It was a foul up. But it is still hugely symbolic. The Serbian government is one of those governments that's obviously not currently a member. It's not currently in the EU, is it? Although I think it's
aspiring.
It's an aspiring member. That is one of those countries which perhaps is closer to another country that the president of China is visiting, which is Hungary. And I think there's a lot of mischief making on the part of the Chinese, and they will continue to do that.
I suppose that sort of outlook looks, I mean, that kind of analysis from the point of view of being a sort of an ally to Putin to crack apart the natural divisions in Europe would be a little bit concerning to Brussels in that regard, at least from a EU point of view. Salah, looking forward to the potential direction of travel in the second half of the year, a lot of expectation was that the market would become much tighter than, and hence OPEC Plus needing or have the opportunity. Certainly, Saudi Arabia, as you said in your earlier point, could do with more revenue from its oil revenue. Obviously, it's taking a big hit, giving up 1 million barrels, sort of that voluntary unilateral cut that it's carrying for everybody else's benefit. But your thoughts to that narrative, that tighter second half, and that OPEC Plus, despite the current oil price, could still have the chance to unravel some of these cuts, or at least some of its own extra cuts that it's carrying?
I mean, our outlook currently is that, yes, I mean, demand is going to be better in the second half still. But I do agree with Neil that when we're looking ahead for the OPEC Plus meeting, I think it's looking very likely that, they have the opportunity to look at the last couple of months and say, look, we need to continue with our output cuts. And I think there's still enough unity in the group to do so, at least to extend into the third quarter of the year, maybe not for the whole second half of the year, but for the third quarter, and then see what comes next. I mean, with that in mind, our supply-demand balances are still signaling a relatively tight market that's supporting prices. I think it's pretty clear that the strategy for OPEC Plus and the de facto leader of the group, that is Saudi Arabia, is still very much focusing on prices. I mean, of course, they would benefit from producing a little bit more as long as oil price stayed around the same level. But I think they will be careful and cautious around not tapering too quickly, not tapering too early, and risk lower prices. And the latest IMF figures are saying for Saudi Arabia to fiscally break even, they actually need maybe an oil price of $100 a barrel, maybe slightly more. But that being said, I think the strategy stays the same. They will focus on making sure the market remains relatively tight and support prices as much as possible, even though it means that they are producing more than 2 million barrels per day below their capacity. And, like I said very briefly on the unity, I think, when you look at other members like the UAE, unlike Saudi Arabia, they are still investing quite heavily to increase their capacity. And, at some point, I think they will push perhaps a little bit harder on getting their baseline readjusted so that they can produce a little bit more. But I don't think that's going to be an issue just yet in this June 1 meeting.
Yes, you would think that the fourth quarter will be where the heavy lifting has to happen in terms of the potential adjustment of quotas. We did have the UAE announce last week that their capacity has grown close to that 5 million barrel target already. It seems going to be a challenge to keep that much capacity off the market so far beyond where their quotas are. The survey question, 2/3 disagree with the US statement that they can bridge this divide. We'll have to wait and see. Let's hope this room is wrong and that they can and do it ASAP. We are all bystanders and have to see where this plays in the coming days. But at the moment, we have Brent crude oil trading down 60 cents at 82.55 on Brent. And that sort of downward motion of the week continues despite the very noisy geopolitical backdrop. We're going to have to leave it there. Thank you so much, Neil Atkinson in Paris, Salah Yilmaz in Dubai, as well as Niamh McBurney in Dubai, and myself in Dubai. It's a Dubai kind of day on the Daily Energy Markets podcast. Usually we're all over the world. Today, we're on Sheikh Zayed Road. Thank you, guys. All the best.